Good afternoon, everybody. Uneducated Economist here. Sorry, I don't have my earbuds and I don't have the dice. I'm in the S10 today, so I'm just going to try and give it to you as best I can here. I'll lean a little bit closer to the camera and hopefully that helps out a little bit. Wanted to talk a little bit about Alan Greenspan's Conundrum, because this is something that I think is probably going to be taking place here over the course of the next few months and probably years, actually. Now, the Alan Greenspan Conundrum, I'm going to leave a link down in the description for you guys to it comes from the Economic Research of the Federal Reserve, and it's titled Further Evidence of Greenspan's Conundrum. And this is a really good little piece. It's not very long at all. And pretty much what it's talking about is that back in the 1980s, they realized that interest rate changes in the Federal Reserve Fed funds rate started to have less effects on the U.S. treasuries, and now they find that there is almost no effects on the U.S. treasuries, and the U.S. treasuries are reacting to news. Listen to this part of it. It says the Fed funds rate moved only when the FOMC changed its target for it, while in contrast, the 10-year treasury yield continued to respond to the news as before. As a consequence of this change, the FOMC operating procedure, the correlation between changes of the Fed funds rate and the 10-year Treasury yield declined effectively to zero. They're just basically saying that it doesn't have any effect on it any longer. So when I hear people say that when the Federal Reserve goes to raise interest rates that the government won't be able to afford higher interest rates, well, it doesn't necessarily mean that there's going to be a correlation between the U.S. Treasuries and the Fed funds rate. Now, I have a hard time believing that there won't be, but apparently this is what Alan Greenspan was talking about. And if we think about it right now, with the news that the Federal Reserve is going to be backing off on their quantitative easing and that they're going to be raising interest rates into the future, that whole perception would lead you to believe that the U.S. Treasuries would probably be falling in price and rising in yield. I mean, if you have this buyer who prints up money and goes into the market and they're stepping away from the market, well, that would lead you to believe that the price of those things would begin to fall and the yields would begin to rise. I mean, it would only make sense without a buyer there. The only thing is that the whole idea amongst the market in a global economy is that if the Federal Reserve goes to take in these steps, goes into quantitative tightening and raising of interest rates, what people are believing is that there is going to be some sort of economic crisis from this, whether it's a liquidity crisis or market crash or some sort of major panic that'll take place that'll cause the markets to go into a downturn, and then the Federal Reserve would have to, reverse its course. But the belief that there is going to be a crash coming into the future, or that there is at least some sort of concern of that taking place, forces people to get into the safe haven. And what is the safe haven? U.S. Treasuries. So as the Federal Reserve kind of puts out this idea that they are going to back off on the quantitative easing, meaning that they are not going to be buying as much U.S. Treasuries, which would lead you to believe that there would be less buyers in the market, causing the prices to go down and the yields to go up, the exact opposite is going to happen, because the world's going into a panic on it, and they are going to get into the safe haven, which is going to be over in the United States, going into the king dollar, right? Going into what is going to be perceived as that safe haven of it. Now, I'm going to leave another, that's really what I wanted to talk about, was Alan Greenspan's Conundrum and how we may be facing that right now. And I found that piece coming from the Federal Reserve, which I thought was quite telling about it. Now, the other thing that I wanted to show you guys is that if you go and you look at what's taking place over in China right now with a lot of these issues that are coming with the corporations and them going into debt defaults. Now, what I found interesting is that if you go and you think about what took place back in the great financial crisis back in 2008, remember shortly after all this was coming down and the liquidity was drying up and everybody was freaking out, remember Bernie Madoff? Remember he became exposed? They were for the longest time, everybody said Bernie Madoff is the man. I mean, if you want to invest, you got to be with Bernie Madoff. This guy gets you what you need. And they questioned him on it. They were like, man, how could you possibly get these returns? And people tried to reverse engineer it, and they're like, man, it's a total Ponzi scheme. This guy is making this up, right? But yet people just kept investing with them, and nobody ever questioned it. Even the Security and Exchange Commissions and everybody else is kind of, I guess, let it go. I don't know, exactly how it is that he was able to get away with it for so long, but he was. Point being behind it is that once it was reversed. Like once the liquidity dried up, once he wasn't able to keep that Ponzi scheme going, it was exposed almost immediately. And now go and check out some of the articles that I'm leaving down in the description talking about Japan. I mean, or not Japan, I'm sorry guys, China, and some of these corporations over there. Because a couple of these, like one of them, they were like, hey, we took $300 and something million and we gave it to this investment fund so that they could invest it to like 7% return, and they won't answer their phone. Like you gave 300 and how many million dollars to somebody, and now you can't get a hold of them? Like you don't know where your money is? It's gone? Like, okay, so you're going into default. Wait a minute, hold on one second. You're not able to pay your bondholders because you don't have any money. And you gave all your money to somebody who isn't answering their phone? And you're telling me that there isn't some sort of scam going on here? I mean, really? And they're not the only ones. I mean, go and look at the other article. There is so much questionable activity taking place over there right now, because this is what happens when you have a bunch of liquidity in the market and it's just flowing everywhere. Nobody seems to care where it goes. Everybody's all talking about being in the money and all happy about it. And then next thing you know, it's drying up and they're like, whoa, it's beyond, okay. It's beyond, like, you see who's swimming without, like when the tide recedes, you see who's swimming without a swimsuit. It's beyond that. You see who's swimming without a swimsuit, and you're seeing who it is who is bragging themselves up to be better than they really were. That's what's going on here. That's when you see those things exposed, like Bernie Madoff. I mean, Bernie Madoff made himself out to be some kind of like, big old star. And then when the tide receded, and he wasn't wearing any clothes, and everybody was like, right? That's what happens. And I mean, I don't know if there's a better analogy for it, but that's really how it goes down. So anyhow, what else did I want to talk about? I think that's it. Uneducated Economist. You guys let me know.